Really? Okay, that's quite interesting. Okay, our next speaker is Alex from Covestor.
Hi, good evening. My name is Alex McAndrew. I'm an investment analyst at Covestor. So let me just get the slide clicker. So what is Covestor, firstly? Covestor is an online platform that empowers clients and money managers to make better investment decisions together. I'll give you a little overview of the business and explain the social angle and how it's applicable to Covestor. So first up, worth taking a little look at the marketplace. The market we service is the US wealth management market, which is a $10.8 trillion market. Over 50% of equities globally are US equities, so it makes sense for an equities business to target the US. So this gives a couple of examples of some of the institutions that operate in this space. Firstly, on the left, we've got the full-service shops. So this is your typical financial advisor who provides a full service to the client, sitting down, understanding your needs, your desires from an investing point of view. A couple of points to note about this offering is, firstly, you don't always get a huge amount of choice. Usually, these guys have specific portfolios that they allocate to personality types. And secondly, it's quite expensive. So you often have to have a number of assets or pay high fees to use them. Secondly, we look at a development over the last sort of 5 or 10 years, probably not innovative enough to be part of this meetup, but certainly something that's changed in the last decade or so. So I'm talking about companies like Interactive Brokers, IG Group in the UK, where you have a full opportunity to trade to your heart's content. A couple of points to note about this offering. You'll notice I've been quite biased when I'm going through these, is that there's not huge amounts of controls in place. So it's not suitable for all investors or potential clients in the market. So that brings me on to Covestor, and we're hoping to take the best of both, really. We run a website which has currently 150 different investment models and is run in a very transparent way. I'll just give you a quick view of the website now and talk through some of the key points. And then we can move on to the more social aspect. So here's our homepage. If I click on some of the models, you can see on the left-hand side of the screen a bunch of tags which categorize the different models by risk score, investment approach, asset class, etc. Just kind of giving an indication of the different options that we have in our marketplace today. If I click on one of the models, for example, long-short opportunistic, for each model we have a model manager page and a model page. So this may look familiar. It's similar to things like Facebook. The manager is able to talk a little bit about himself. We're able to publish some risk score and some performance and risk metrics. We can see model commentary. So this is content produced by the manager, performance reporting, any investment views he has, etc. And then we have information on holdings, performance, and some more detailed risk metrics for those people who are keen for a more in-depth understanding of the risk-return profile. Great. So why a marketplace? What's the structural driver at play behind our business? Well, the founders of the company noticed that marketplaces were having a huge impact on a variety of different industries, really disrupting traditional methods of doing business, providing opportunities for individuals and also the people offering, both sides. So you can see there a bunch of different examples. I'm sure in the finance space there's people here today with countless more examples within financials. What is it that makes a marketplace successful and why our marketplace is valuable? We have some reasons listed here. Pricing transparency. What that means for Covestor is, I can give you a couple of examples. For example, we have no load fees to our funds versus a typical mutual fund, and we're extremely transparent in that we include every transaction cost and brokerage fee in our performance reporting. Hidden jewels. So if you take a look at the website, you'll see some investment options that may not otherwise be possible to access. So for example, hedge fund-like strategies using leverage, using a variety of exotic asset classes. And then onto the next point, which is sort of combining the next 2 or 3 bullets here. We do a variety of different analysis to give models and managers risk scores. We take the brand very seriously. We curate the platform to make sure that those models being offered to clients are suitable and clients are directed to models that are suitable for their specific investment goals and needs. And then finally, brings me on to this point of social integration, which we touched on when we saw the model manager page and some of the content that they were producing. So content creation is a big part of our business. We have an in-house content team of people producing, I think we publish maybe 10 to 20 different articles every day. Some of this is probably picked up by a number of the other businesses that have previously spoken this evening. We then distribute that content via our website and blog. I'll quickly flick up the blog in a second, but also via some of these other startups and more established players within the financial ecosystem that we're operating within online. Let me just click up the blog quickly. So you can see here we've got not only commentary, which is more frequent than you would typically get from a mutual fund, but we also have profiles of the managers, we have Outlook, we have various different articles on strategy. This is being produced by our in-house team as well as the 150 or so model managers that we have on the platform. And with each of these, there's a huge opportunity for social interaction between clients and between those managers. So as with every blog, there's opportunity at the bottom to comment, and we see interaction back and forth between managers and other individuals alike. So then just a couple more slides to get through. I guess some people in the room probably work in the fund management industry, so maybe interested to a certain extent as to how this is possible. It's not a typical mutual fund model. In fact, one key difference is that each client and manager has their own individual brokerage account. We will receive the trades done by managers as an indication, which we will then run some filters on to check for suitability. So we're looking at things like liquidity of the security, is it a long or a short position, the market capitalization of the security. After that processing, we then calculate for the clients that have elected to follow that model, if the trade meets our filters, the number of shares that we will be replicating in that client account. And this all happens within seconds. This slide also highlights a couple of the benefits. So on the client side, they have access to this wide array of different strategies that they may not otherwise have access to. They have the curation that we talked about earlier, and also the performance reporting transparency. We publish performance on a daily basis, and as also mentioned previously, a lot of content, news flow, etc. On the manager side, this is actually a key point, which some of our previous speakers tonight have alluded to. We take out a lot of the hassle from running a portfolio, so there's no need for the manager's own compliance function. They don't have to worry about fees or reporting. They can, if they want to, they can just run their portfolio from their own account, and as long as they're within our rules, which are fairly straightforward to understand, they can sit back and take part of the management fee. So then just finally to wrap up, just to highlight, we're proud of some of the managers on our platform. The top stat's my favourite, that more of our managers consistently beat their benchmark than in the mutual fund industry. So that's kind of it, basically. That's an overview. Our goal is to provide a better investing experience and ultimately help people. So thank you.
Okay, do we have any questions?
I have a question.
Sure.
What's the number of investors you have on the platform? And then what's the average size of the account?
It's a good question. I probably can't tell you exactly how many clients we have. I mean, just to give you a broad idea, we're looking to grow assets on the platform. So we've got a fairly small amount for a typical asset management company at the moment, but we're kind of making a few developments to our website, which will then allow us to turn up our marketing filters and really grow things aggressively over the next year or two. The most interesting part of that question, though, was regarding the account size, because this is a product which is targeted at the kind of lower to middle end of the wealth management industry. So the minimum that a client needs is $10,000 in their brokerage account, and we have models available for subscriptions of $5,000. We set the investment minimum level based on things like, whether they will manage to replicate all the positions and what the trading cost percentage will be, and we have to meet acceptable thresholds there. But for models with not many positions and low turnover, we can set the minimum at $5,000. So it really does give access to people that may not otherwise be able to get access to these sorts of strategies.
Hi there. Just a quick question, and this will tie up with the discussion we've had in the lobby before the presentations. Are you FSA authorized? And if so, which authorization do you hold?
Sure. I mean, we are SEC authorized because we are operating in the US.
I see.
As to which specific regulation or authorization, I'm not entirely sure, but we're fully regulated in the US by the SEC. And the actual, because that is certainly something in our business which is a bit different. We effectively, for individuals who are not registered investment advisors, we use a publisher's exemption. So the business is structured that they effectively sell us their data in the same way as somebody publishing a newsletter. We take that, we run our suitability checks, we run our filters, and it's us that's making the decision to then invest on behalf of clients.
And that allows you to carry your business out in Europe, for instance, under the US regulation.
We haven't expanded into Europe at the moment.
So you're only within the US.
We're targeting the US market at the moment. The business's head office is in Boston. We have a development, operation, and investment management team in London at the moment.
Cheers.
I just want to drill down into a bit more detail on that last question. You're basically, my concern is that you have a situation where people are investing money into something that they don't fully understand and isn't perhaps as regulated as well as a conventional hedge fund would be, because people are following individual feeds within that. So how does the level of protection for investors compare? Are people particularly vulnerable to, say, black swan events, which can wipe out, a large number of, the small investors could be negatively affected? Because you can have something, you can have trading strategies which perform, moderately or above average in the market generally, but they're just more risk. They're trading stocks that are inherently more prone to big drops when you have black swan events. So, my understanding from your answer to the last question is that you are the hedge fund, right, or you are the investment vehicle, whatever you would call it, and people are investing in you. So, how do the risks differ, and how do you protect people who are potentially quite, retail as investors?
Sure. Let me pop up the website. We are effectively the investment advisor. I think the key point is guiding clients to strategies that are suitable for them and making sure that clients understand the risk profile. In terms of the regulatory side, I don't really want to get into that because it's not really what I do in the business, and I wouldn't be able to give you a correct answer. I mean, feel free if you have any concerns to drop me an email afterwards. But I can talk a bit about what we do to make sure that clients get suitable investments. And that would be things like the risk score, which we provide, which is very transparent. So this is a risk score 5. It's a 1 to 5 scale. Basically, anything above a 2 comes with risk of loss. If it's a 4 or a 5, there's significant risk. And this is all quite clear, hopefully, on the website. Another thing that we do is the curation aspect that I talked about. So we've got 150 models on the platform. Some of those are quite risky, but they've all provided us with a track record of, a decent enough length that we're confident that they're implementing a specific strategy which has a risk and return profile, allowing us to provide them with a risk score, and therefore matching that up to clients' individual risk scores as well. We hope to do more in this area, actually, in terms of guiding clients. But we feel at the moment that we're covered from that angle.
And as a supplement, if I may, you said that when a trade comes into somebody's feed, right, then you rate that trade. So you've got the feed coming in from the investment, like the person you're following, essentially, right, and then you're filtering the recommended trade that they're suggesting to find out whether that individual trade is suitable for the individual investor. Right, is that how you're working? Because that's how I understood it.
Not quite. We receive the trade from the broker, who the manager sends it to.
Yeah.
We then decide if it's suitable for the model, and the client has already been determined to be suitable for the model based on the risk profile of the client.
Okay, so to kind of drill down to that,
sure.
The bit that I'm fundamentally concerned about in that is that when you're picking and choosing trades that are recommended to you, which is what I understand is happening, you get these recommended trades coming in and you're picking and choosing some of them. Is there not a big risk that you then distort that model to such an extent that it's no longer really the original model?
That is a risk, yeah. I mean, we typically require / encourage managers to trade within the rules and adhere to their risk profile. If a manager is constantly, or if we see a behaviour where they are trading outside of the rules and trades keep coming through which are ineligible, we will very quickly and swiftly take action.
All right, so more, for example, okay, so just to make sure I understand it, so if you're trading oil and gas and then you put a mining stock in there, that would be the sort of thing you'd knock out. It's not that you're filtering the oil and gas trades, it's that you're basically saying if anything's non-compliant with the little micro fund that the person's operating, then you knock those ones out, right?
The crudest example, say, it's a lower risk portfolio and the manager typically buys large cap dividend yielding stocks, and one day a trade comes through and it's a short position in a micro cap. That would get rejected.
Okay.
That's a crude example, but that's effectively it.
Thank you very much, Alex. Thank you very much, Alex.